Hey guys, it's Max Convexity. Thanks for tuning into my channel. Today's a very special day in the history of my channel because I have Jay Pestrichelli, the manager from Zega Financial, on with me, and I'm going to put him on the hot seat and ask him a bunch of questions. How are you doing today, Jay?
Good, Max. Thanks for having me on. It's long overdue. Glad to be here.
Well, yeah, happy to have you, Jay. All right, so let's start with this. How did you get into options?
Oh, wow. All right. Well, that's kind of a long story. So I started in the business in 98, working for a little broker called Daytech Online. I always liked the stock market, but, didn't really get into it until then. And, our company at the time was rolling out options to our clients. This is like the internet boom of the self-directed
Yeah,
brokerage space was happening. And so they needed someone to start to learn it and, get familiar with it. And I'm a math guy. I'm an engineer by education. And so options always seemed really interesting to me. So just started learning it and then got into the education for the clients of the brokerage firms. And when my firm merged with Ameritrade in '02, I continued to kind of run the active trader business there. And that had a lot to do with options. And then it just continued to grow. And we found that, folks that really engaged with options were, more active. They understood income. They understood protection. Sure, they speculated a lot as well, but it just ended up being such a popular and useful vehicle that my time there when I was running the trading business, we just did a lot of communication about it. And then I launched my firm, and my firm, Zega Financial, is all options based. So I just felt people didn't understand that options were more than speculative vehicles. You can invest long term using options. You could use it for long term protection. You could use it for alternative income. And so that's, everything that we do at Zega Financial is options based. So yeah, it's kind of a weird, most advisors don't take that path. Most fund managers don't take the path that I took, but I really started with helping the do-it-yourselfers.
well, I got into options the same way. I actually was in financial planning in the '90s and was Series 7. I was a broker, but I was the guy in my firm that people came to whenever they had an option question. Hey, how does this work? Or I would help guys to pass the Series 7 because the option part's the hardest parts for a lot of guys. For me, it was the bonds. Okay, but I wanted to ask you, you said engineering. So did you go to college for engineering?
I did electric power engineering.
Wow. Oh my
Yeah.
gosh. Which college did you go to?
Rensselaer Polytech Institute up in Troy, New York, upstate New York.
Yeah,
RPI.
I've been reading your book, Buy and Hedge. I haven't finished it, but I like it. But I noticed in there you said you live with your wife and in Omaha or Nebraska somewhere. So what's the Nebraska connection?
Well, I did. Yeah, when I wrote that book, I was living in Omaha. That's where TD Ameritrade headquarters is. Now it's Schwab. But so when my firm, Daytech, merged with Ameritrade in '02, I stuck with the firm and I went out to Nebraska. And I lived in Nebraska for 11 years. And now I live in Florida. I moved here in 2013.
Yeah, I knew you lived in West Palm now, and that's awesome. I bet West Palm's a great place for financial planners. There's a bunch of them in Austin too. I'm from Austin. There's a ton of
Yeah.
private equity and also a ton of, but there's all that kind of stuff.
Yeah,
Um,
I mean, I feel like I got here a little before the wave from New York, right? You got like Wall Street South now between, from West Palm Beach down to Miami. So a lot of firms are moving here. That's not why I moved there. I moved here. I thought the taxes would be better. Turns out kind of. But yeah, and the weather, of course, getting out of Omaha for Florida weather was not a hard choice.
Yeah, the way I look at it, that's the way I measure if somebody's made it in life is if you can wear shorts every day. I wear shorts every day, but that's my home. That's my own way of. My dad lives in California. He lives in Southern California. He wears shorts. I just think when you're retired, you should go to a warm climate. There's a lot of
Yeah.
brokers that, a lot of money managers and brokers live in West Palm, of course, but a lot of them live in like Scottsdale. A lot of people seem to go to Arizona after they're done with Chicago.
Yeah.
The
Yep.
Chicago
Midwest goes that way. East Coast goes down to Florida. You got it.
Yeah. All right. Well, now let's get into some of the more. I want to ask about actual options, but I just
Sure.
just wanted to ask a few basic background questions. I was just curious about all that stuff.
No
Okay.
problem.
Well, first of all, I want to start and I want to congratulate you for introducing Spy Tea. I think Spy Tea is a genius idea. I love the idea of Spy Tea. To me, there's two problems with these funds. One is they have pretty much unlimited downside, but the other thing is they don't get much upside. Well, you solved one of the two problems. I love it.
Well, thanks for that. I tell you, it's one of those things that you start to learn as you go, right? And when we started with Yield Max, covered calls on the high volatility and those things was very appealing. But as we started going down the path and we said, look, some folks want alternative income plus upside, right? So, and we had always thought like, well, you could buy half the stock, buy half of one of the Yield Maxes, and you could kind of replicate it on your own. But I like this kind of hybrid exposure on SPYT for sure, because of that, excess capture on the upside. Like we were saying just before we hopped on here today that the market got a nice little pop at the end of the day. It's exactly like you don't know when that's going to happen, right? So having exposure to that upside move is the nuanced piece of it, and then having that targeted amount of distribution can give you a little bit of a leg up and add in that extra kind of alternative piece of it all. So taking advantage of the option premium.
Absolutely. Now, you've mentioned before that you tried to capture 25 basis points on the triple QIs, right? That's your goal?
We try to. Yep,
Okay,
it's hard. It's hard with a VIX with a 13 handle, but yes, we try.
Of course. But what do you try to catch on? What do you try to catch on these call spreads that you sell with Spy T? Do you have a 10 basis points or?
Yeah, we have a number on that. I think you'll see the first announcement of the dividend tomorrow morning. So by the time this video comes out, if you promise to post it after, I can tell you. But yeah, I mean, it is a lower level than the JEPY or the QQQY, right? It is more in that more of a defined range, which is closer to some of the others. So I'm gonna decline answering exactly, but watch for the press release on that one, and I think you'll get a really good idea of what our target is.
Let me ask you this, because that leads into another question. Does it make you mad, or does it make your job harder when there's people out there on the internet dissecting the trades and guessing what the dividend's going to be? That's kind of how I made my mark, is being able to guess the dividend.
Yeah, it doesn't make my life any harder. I love that the funds are interesting enough that people want to dig into it and get an understanding of it. Doesn't make our life any harder. We're pretty, look, when you launch any strategy, you have to kind of set, even though they're actively managed, you set your rules and you get disciplined to those rules. While we certainly do listen and hear what a lot of folks are saying, there are parameters we're kind of stuck to, right? And so what I would say is I love the fact that everybody is interested, that folks are watching your videos and watching other folks' videos and trying to get an understanding of what's coming out with the funds. You save actually me a ton of time and educating. And actually, I want to compliment you for your accuracy on the way that you look at options. So I've always the videos that I've watched from you, I appreciate your accuracy on them. And you don't speculate too much about what we're thinking, right? You're like, well, they did this. Here's the strike. This is what the result is. Maybe they did it for this reason. But yeah, I appreciate the education. And I do love the fact that folks are talking about the funds.
Well, perfect. Okay. Well, something I saw in your old interviews is everyone wants to tell you a kind of ETF to come out with next. And then they want to say, hey, Jay, are you coming out with one that does a butter flavor, whatever, So I'm going to stay away from those kind of questions, but I'm going to tell you, since I have your attention, I'm going to tell you what you need to, or I'm going to just, if you were my business partner, if we were in business together, I'd say, Jay, we have got to come out with the fund where you sell that 65 Delta put. That's money. We sell that put and we buy a 25 Delta put on a daily basis. Well, we can only pay about 20%. We call it a target fund, but we cut off all of the downside. We don't have any more down 2% days. But anyway, and I know you can't comment on that, but I'm saying that's what I have been wishing for since the day that these funds came out. But then when I saw Spy T, I was like, that's the different way of solving the same problem, kind of. And I fell in love with Spy T, but I really like my way too.
Well, look, I mean, your way is virtually a collar, right? And at here, the first fund that Zega launched was a hedged equity fund. Like like taking away the downside when we can. I will say this: there are funds out there that are hedged, right? The Buffords are a big deal now. A lot of folks are using those. Those are longer period than a 1 day trade. I'll tell you, I like the idea of using that put spread, which in this case really will behave like a collar. Um, it's not something that's outside of our discussion, right? It's something that we've certainly talked about with our partners. The concept of the collar, though, sometimes people get worried it's too complicated. I don't. You wouldn't worry about the complication of a collar, right? Long put, short put, pretty basic stuff. But sending that message, is it the right thing that'll resonate with the market, is tough to know.
Well, isn't a caller where you sell a call to pay for a put? I mean, when I think of a caller, I think of that. I'm thinking you're selling one put and buying a different put. I'm thinking selling a put spread instead of
Yeah,
selling
well,
a
if you think of the risk graph of a collar and a put spread, remember
well,
our in the money put acts as
true,
long stock short call,
true,
right? It's the
yeah.
replication. So now we're slapping a long put in with that kind of replicated covered call. So and it wouldn't be a zero cost collar because of course, like you just said, you still want to have income.
Yeah,
So you got to take a look and figure out where the extrinsic cost of that put will be.
I'll put a pencil and paper to it, and I think a fund could do that and pay 15%. I would just, if it was my fund, I would call it a target fund. I would say it's going to pay around 15%. It would still be better than JEPQ and JEPI and some of the other big guys out there. And I mean, that's my idea. But like I say, now that you've come out with SPY-T, I don't know if you're right. I don't know if it's, okay, there's two problems with these funds: the unlimited downside and the no upside, or the
Yeah.
lack of a. But so SPY-T solves one problem, mine solves another problem that I see as a problem. But in any event, SPY-T is definitely a step in the right direction. And I was kind of embarrassing because I told everyone, it's not embarrassing, but I told everyone I know to buy triple QY. So it's a great opportunity. Not hardly anyone took me up on it. My dad thought it sounded too good to be true. I wrote him practically a white paper about it. Couldn't make the sell.
Okay.
But I had a friend though. I had a friend that actually bought some, and he told me on Sunday we were having dinner, and he said, I bought some of that QQQY. And I was like, oh, did you? Great. But I'm going to tell you about a new one out there. It's called SPY-T that you, I mean, anyway, I gave him the rundown, and it's great to have choices.
Yeah, and you know what? And this is public knowledge. I can tell you this: we also filed QQQT, right? Where we'd be doing it on the NASDAQ, and we have a Russell one too. So those are filed. Those are obviously not live yet, but could be, right? If we think there's been some pickup on SPY-T, right? We're in our first 17, 18 days, and we're seeing some volume on it, which tells us people are using it. I was just curious. I'm just looking at my platform over here 1 second. So when I look at the volume on SPYT, yes, 30,000 shares traded today. It's not, crazy, but we're doing more shares than the Pro Shares products and the Roundhill products on a daily basis, and it's newer. So when I look at, when I see that, it tells me, okay, the market likes this idea, which means we'll probably launch a few more, right, and spread it across the indexes. By the way, the other thing I was going to look at when you asked about when you were bringing up the put spread, that I coined as a collar.
Yeah.
Yeah, you could do it. You'd be buying like the 14 deltas versus selling the 60 delta put. So you could do that for a little bit of income. I don't know if we can get 15% a year though on it. So, and
Yeah.
it could be a matter that you got PCE tomorrow, so the puts are a little more expensive out of the money. But yeah, you could take a look at those things. That one is 0.5% out of the money. If you're willing to go 1% out of the money, you almost pay nothing for that 1 day option, like 50 cents on an SPX put. So maybe that is the way to go. Just take out the -3% days, right?
That's all.
The minus twos.
I get so many comments about that. People just, I mean, but there's a counter argument to that. And the counter argument is QQQY won't go down near as much as QQQ on 3% down days by about half a point. Or okay, but or
By the juice, right? By the extrinsic we sold the day before, right?
but the problem is that if it recovers real quick, you still kind of realize that loss. Where okay, I don't like the funds that do monthlies, like let's say JetQ that does a monthly strategy, but on a monthly strategy, they don't get as much premium and stuff, but they explain to me what I'm trying to say. Do you know what I'm trying to
Yeah,
say?
so they cap themselves for, potentially weeks at a time. So when you have a run like this, they'll sell in at the money, right? Call. By the way, JetQ and QILD, I'm more familiar with QILD. It's been around a lot longer.
Yeah.
They'll keep some of the premium, they'll distribute the 1% a month, but they have that option. Like if you look at a chart, right, it kind of goes up and then goes sideways, goes up and goes sideways. So they get that, income that they're going to get from selling the call, and then they're kind of capped. Whereas with QQQY, instead of selling one call for 20 days, we sell 20 puts for that 1 day at a time. It's one of those things that more bites at the apple. But your point about the snapback days, you can find yourself, you will find yourself underperforming on a daily basis with QQQY. However, it's all just a matter of timing with QILD when that happens, right? They may not drop as much on that day, but if it's options they just put on, there's no scenario that I would say, Max, where there's one approach to options that beats all the others, right? It's a matter of what happens more often. And for us, we think that those shorter terms, a lot additional bites at the apple, dragging in the extra theta decay, the time decay each day, over time should outperform that 1 month option that gets sold.
Yeah. Yeah. No, that's what I thought she'd say. Let me ask you this. So I've been telling folks they need to reinvest 2/3 of the dividend. And I looked at a study and I based that on some stuff in the QQQY in the Defiance ones. Now, not in SPY-T. In SPY-T, I think you're fine just spending it. I mean, still working on that, but I really think the reinvesting 2/3, you almost have to do it. But some people are unwilling or just, I don't know.
Well, look, I will tell you, when we first launched these kinds of funds, we thought, like, hey, we should just do the reinvesting for them, right? If we didn't distribute the cash, that cash would still be in the fund, and each day we'd have more and more to invest, right? And so as the fund grew and you earn that time decay, you naturally be reinvesting, just like if you were doing it in a personal trading account. But we realized some folks want the yield, right? And we thought the yield story was compelling enough to distribute it. But we've always accompanied that with, you should reinvest. Otherwise, you're divesting to cash, right?
Yeah.
If you're, I want my 50%, but you realize you're naturally just letting it, the position will move to cash. Now, we can all have the NVIDIAs of the world and the Conys of the world and the Misties of the world that just seem to go up. But I would say that, when you look at the dailies like JPY and QQQY, IWMY, I agree with you. We would recommend, unless you're trying to go to cash, we would recommend you reinvest those dividends because of the dynamic of, the in the money put, or what a covered call will do, where you're not participating in the upside, you get all the downside. You want to make sure you're reinvesting that. Now, the 2/3 I hadn't heard of before, but as an advisor, there's this thing we call the 4% rule. You were in that space. You probably heard that before. Yeah, you want to take some money out. The general rule of withdrawals, if you're, say, in retirement, is take 4% out, not a month, a year, right?
Yeah.
So set the amount that you want to pull out. You want to pull out 10% a year, got it. You're taking out 2.5 times what an advisor would recommend, but that's your preference. But if you're not taking it out because you don't need it, what are you going to do? Just leave it in cash? You should reinvest it to keep your balance up, to keep your allocation the proper size.
Well, you had an interview and you basically told everyone, if you don't want any of this bad stuff to happen, just reinvest all of it. You can, and it's a good point, but a lot of people push back on it so hard, and it's no fun to make 60% and not get to keep any of it. So I found a study that's based on a CBOE. I'll email you the study. Maybe you'll like it. But I found a study, and I think the study shows that the 2/3 is kind of the sweet spot if you want to have good NAV performance, but at the same time be able to pay yourself something. Now,
Yeah, that's probably before there were things that yielded 50, 60, 100%, right?
there was only, yeah, there was
Yeah,
only weeklies and monthlies, but yes, you're
yeah,
absolutely right. It was
yeah.
before that. Yeah. So but that brings me another question. Do you have any,
Sure.
I mean, do you have any back tests on dailies, or is there a daily benchmark? Like for a covered call strategy on monthly, it's easy. The CBOE has multiple benchmarks. You can go back and see how 2% out of the money would have done, or 1% out of the money or whatever. They even have benchmarks for callers and everything, but I could not find a 1 day benchmark.
Well, the 1 day option availability hasn't been around all that long,
Yeah.
right? So you got the middle of 22, I think SPXs went daily, October of 22, NDXs went daily. Rut we just got every day, right?
Yeah.
Thank you, SIBO. But they did that actually because of our fund. We reached out to them and we asked, and they said, sure, can you just wait till the new year? And we said, that's fine. So there's not enough history there unless you're going to go do the isolation of like, okay, let me look when there was just Fridays, what every Friday did, right? Like that, there is a way to go do that, but I don't think the SIBO is going to create a benchmark like that. I think they're going to have to wait for a little more time frame. I'm not aware of a daily. However, the SIBO does do plenty of studies on, the 0 day to expiration options and what happens through the day. Every time that they've been blamed for some sort of a market volatility, SIBO has come out and said, nope, actually turns out it's all just fine, right? The same number of buys and sells. You got the spreads in the morning. You got expirations happening throughout the day. And at 3:30, there's a flurry of people just taking the directional move. Like that's normal stuff that happens with stocks, right? So I think that is a little more information you'll get, but nobody's done as far as a back test goes. Now we have with, before we launched the fund to get an idea of like, hey, is this really going to work or not? And so we tested from the start dates of the everydays when they were available. But again, it's a limited period of time, right? It's nothing that goes over too long of a period. But I would tell you, I don't know how you feel about this, Max. As an options guy, I haven't really worried about disruption to the marketplace because of the same day option expirations, like every day. I mean, there's always been triple witchings, but do you hear about triple witching anymore? Quadruple witching?
Yeah.
Nobody talks about it anymore because every day you can have people who are trading, almost no theta decay and they just want to trade directionally. And it's fine. It hasn't had a problem yet. So I haven't been so concerned. I don't know if that's anything you've heard in my space in the industry. You certainly have people that are more worried about market structure, and they've just questioned. But so far, things have been good. But everything's good when the VIX is at 13, like nothing's blowing up. Let's see how these work when the VIX is at 50.
Yeah. And I get that comment all the time too. People say that I don't know what I'm talking about. And whenever the market takes a serious downturn, these are going to explode and stuff. But anyway, I'm trying to find ways to educate the people that won't happen. These will actually do better, as you know, in a downturn compared to the broader market.
Sure.
Now,
Sure.
so I've got a Tasty Trade back tester that I love. And anyway, you can go back test and test through, it used to just be Wednesdays and Fridays. So you could do 2 days a week. So I went back to 2020 and I'm trying to recreate what would have happened in February, March of 2020. But anyway,
I think that would have been rough, right? Because there were some days where the market rebounded just as much as it declined the day before.
yeah.
So I think in that kind of an environment where you have those really dramatic, spikes and dips, I think that the in the money put strategy will underperform, certainly get a lot more volatility, right? So you get a ton of extrinsic each day, but because of the lack of upside participation, the structure itself, I think you'll find that, and I didn't run those days myself, but intuitively, I would say you probably underperform the market in that scenario.
Okay, well, yeah, that's I wasn't expecting it to be good, but I just wanted to check to
Hey,
what.
nothing was good in
Yeah.
March of 2020.
No, but no, that's a good point. And so that brings me to another question, though. I mentioned in my email that I wanted to ask you about the efficient market hypothesis.
Sure.
And the reason is, I'll just let you tell me. I read the book called A Random Walk Down Wall Street when I was a broker in the early 90s. I figure you did too.
I did.
Okay. Well, and that is kind of tied in with the efficient market hypothesis. Then also what happened in 93 was ETF came out that's done pretty well called the SPY, you know, and that was kind of that I know indexing was a thing before that, but that brought indexing just front and center. So how does that have to do with the trading strategies? Do you believe in that? And just tell us what you think about the efficient market hypothesis.
Yeah, so I think these days more than ever, all the information that's out there is included in the pricing of options, right? We let the options tell us what strikes we're selling, where we put our hedges, right? The data is all built in there. Now, is it right or is it wrong? That's a little different. But I absolutely can see in option prices every day, upcoming news events, market fear and greed. You could see that in the options. Certainly, a skew is a big thing. We don't have to go into that. So I do think they're built in there. I do think anything that you could think of is priced in. I'll tell you, like every night before the CPI report, and this is even before, dailies, you could see the implied volatility in there. Every day before the jobs report, you see the market going, okay, now, do I think it gets the direction right? No, because the options market will kind of ripple out that volatility. So even if you see a lot of folks buying calls because they're bullish, it will make its way into the put side because it has to. Otherwise, you've got an arbitrage opportunity. So, that's just the way the options market works. But when you see volatility going up, it tells you there's an appetite for speculation. A lot of folks be like, ooh, VIX is the fear index. I always push back on that. It is a speculative rating, right? It is just tells you how much people are willing to pay for an option today compared to the same option a day before or a year before. So I do think that information makes its way into the options market for sure. The stock market, of course, is a natural reflection of that as well. But I think the market could be wrong all the time. I mean, it happens, right?
Yeah. And that's kind of what I thought you'd say. I listen to the broken pie chart all the time. That's a great test. But then I've heard you talk about VIX in there. I'm fascinated with VIVIX, VIX. Tell me what you think about. Do you like VIVIX or what does it do?
Well, VIVIX is yes. So the VIVIX is, quick for everybody's information, is the volatility of the options on the VIX, right? So VIX measures the applied volatility S&P 500 options. The VIVIX measures the IV of the VIX options. So we use that. There's a lot of information you could glean out of the VIVIX. Let me see where it closed today. I'm sure it closed below 80. Yep, 76. So you could use the VIVIX as a very good indicator of, again, how much are the hedgers and speculators willing to pay for options? Because if you're trading in VIX options, you're fairly sophisticated. If you're not, you're not going to last very long. I have paid tuition multiple times on VIX options. We all have. I'm still here, so I guess I figured something out. But watching the VIVIX is a great indicator to see, how fearful or how speculative the VIX market is, which of course is as we just mentioned, a gauge for speculation on the S&P. So I'll tell you, one of the things we do, not in any of our funds today, but we run kind of a quant on volatility within our SMAs and separately managed accounts. And one of them uses data on the VIVIX and the VIX. And the VIVIX is a really good, for us, a fairly good indicator as a projection of what's coming in volatility. I asked, I mentioned a second ago, I said, is it below 80? And it's at 76. You should take a look at the average returns on a 20-day after the VIVIX falls below 80. You'll find that you have lower than average performance and you have lower than average volatility, right? So it's a really good predictor from our perspective of whether the market's going to be, slow movements or big movements. You look at VIVIX over 130, you start to get a lot different perspective. So if you ever do any back testing with VIVIX, take a look at those two data points, Max, and I think you may find, it could give you an idea. It's not always great on direction, but it certainly is pretty good on expected volatility.
Okay, yeah, I love VIVIX. Let's talk about TRES real quick. TRES. Sure. I love that. I love that strategy. I thought I discovered that strategy. I used to call that I started doing that in 2020 on earnings stocks as a way to YOLO. And I loved about the profit and loss graph, you could make it where you didn't have a loss. Now I knew that you really would have a loss, but those trades can look like they're risk-free, which is dangerous. But anyway, when you were doing that, when you did that, I could not believe someone's doing that. I'm fascinated with that.
You
So
did a
you
great
have,
analysis of that video, right? Where you showed kind of the W risk curve, right? The P&L chart on that.
yeah,
It's not the easiest strategy to manage. It's look, right? It's so for those that don't remember what it is, I think you did a good job calling it a double diagonal ratio. It's exactly what it is, right? So, and in our case, we are long more shares than the ones we're short, long more contracts than what we're short. So it ends up being a long volatility play, right? You're hoping for big moves either way. And in Trez, we're doing those on TLT. We can do it on IEI or IEF. Any treasury based ETF, we could run that option strategy. And it sounds complicated, right? Double diagonal ratio, like what is that? It's really, we're long volatility, right? We're trying to get long understated volatility in that ETF. So it's not like any other kind of overlay that you see on the market. So you're right, it is fairly unique. The management of it is a little difficult because you have to be active. You can't really do that when it's a set it and forget it kind of a build like you can with, say, a covered call strategy. This one you have to decide when you're going to take one half off or leave the other half on, and hopefully you don't get whipsawed on it.
yeah, yeah. So is it the same theory as far as the options you sell have extrinsic, so you're capturing that, and even though since I've been watching it, you haven't had any net profits, but you've been capturing extrinsic the whole time, which is enough to pay a small dividend with, I guess. What are you guys paying? Like 12% or something? I forgot.
Yep, that'll also be in the Defiance
Well, yeah,
announcement
I don't mean
tomorrow
the
morning.
morning.
Yeah, so I think you're right. Like your math is right there when you look at how much we sold the short put, the sold straddle that we sell every couple of weeks. You're right. We are earning time decay on that. You're right. It's no mystery. You look at the chart. We haven't had a profitable event yet, but it's one of those strategies where, you get one winner every 3 or 4 months and it pays for all the losers and then some, right? Because you're waiting for that underpriced volatility to pay off, right? So it is a very different approach. The market hasn't seemed to adopt it yet. It feels like treasury ETFs are going a little out of style. But at the time, when that ticker, I think it's a great ticker, TRES, as a treasury type position. But at the time it was, we thought it'd be interesting. We'll see, how the market continues to react to that. But you are right. It is, there's really nothing else out there like that one. That is a unique option tactic wrapped in an ETF.
I think it'd be a good hedge for other positions. I'm always thinking in terms of hedging, but I think if a guy maybe had some TLTW where it was a bullish bet on a bullish to neutral bet, maybe half of that and maybe half of this other TRES, and hope that you make enough from the one to pay for the other. But then if you have a big blow up explosion type thing, the TRES will pay, and hopefully you'll get your big profit. I think that could have use hedging. My only comment on that, it just freaked me out that you guys, well, one way to think of it is you're selling a straddle to buy a strangle, right?
Correct.
Yeah.
Exactly right.
So, but you're buying the strangle twice. So you have more long, which is cool because it makes you long, but doesn't that also make you bleed to death? I mean, it's no longer like on the selling the short puts, that is an accretive strategy. You're going to make money for sure over time. You win 70% of the time. But on this strategy, I don't see like a huge mathematical advantage like you have in QQQY.
Yeah, the way you were saying it, I think Max was good. I'll add one caveat, right? So you're right. We're twice as long versus what we're selling, but we're selling 2 times versus long as we're in. So if you look at the date difference, right? So I'm selling every 2 weeks, and the ones on long double the size. That's a 1 month position. So the idea is sell twice to pay for the one that's double. And so I don't know when the volatility is going to come, right? So I like having the excess long exposure as much time as I can, and selling the twice in theory should help pay for the, the double the contracts we have on the long end of that strangle.
Absolutely.
That's the idea.
Well, so isn't the problem with those types of trades that it's hard once you cash them in? How would you cash it in, and how far does it have to move? Would you just rebalance up there, or would you do something? But the problem is you can only cash in a hedge once, right? Because then it costs too much. If you have a big volatility event and you take off the hedge, then the next day it would cost too much money to put that same position on, and you may not even want to. Or how would you do it?
Yeah, it would be a rebuild, right? So let's say we get the move that we want. TLT goes up 2% or down 2% in a single day, right? That strategy will be positive in that scenario. And you say, okay, remember, this is a treasury-based strategy. We're not shooting for the moon. We're not trying to make 30, 40, 50% a year, right? It's a 15, 20% overall kind of a build. So there are levels, we haven't hit them yet, where we would then close that and then just rebuild the whole thing at that spot. Because what we found is sometimes that whipsaws back the other way pretty quickly. So I could make it back the other way. So if TLT had a -2 and then followed by a +2, well, we could win on both of those. It's about rebuilding the position. And yes, some of it is going to have in that scenario, that short put will have a loss, but I've got twice as many long puts. It should offset that, right? And plus I made money on the short call. So we would just rebuild it. Exit it all, rebuild it all.
Yeah. There was one time it looked like there was one time I think you could have done that back like about a week or two after it started. It moved up pretty far. Did you even think about rebalancing? I'm just wondering.
Oh yeah, actually we did. The limit orders were in. It just had to move a little farther before those got hit. But absolutely, you got it. It was like the first week.
Well, that's what I figured. I just didn't know how far it had to move, but maybe you kind of gave it away when you said 2% in one day, or those are the types of moves you're thinking.
Those moves will be profitable. And again, we don't, we want to make it. We understand that there will be more losing months than winning months in Trez, but the winning months will be bigger.
And that's what I mean when I say bleed to death. I'm not trying to insult you or whatever, but
no insult. It's time decay. Yeah, we have time decay. You're absolutely right. So that's why we make that one a month long. It's a little less of a rate.
Yeah.
And you also notice they're a little farther away from the money, right? So hopefully, we're more in like a 40 delta versus buying 50 deltas, right? So we try to save a little money on that as well.
Yeah, no, absolutely. But yeah, I absolutely love that strategy. All right, well, it's about time, but do you have like 5 more minutes and I can make
Of course. Yep, no problem.
All right, well, let's see what else, because I got some good questions. Okay. This isn't my question, it's from one of my viewers, but he was asking if you had thought about changing the declaration date of WiMAX to maybe make it the same as the other. I don't have any WiMAX, but maybe make it the same where it's not staggered. He's probably frustrated. A lot of people think that we call it high yield tourism, where people pile in at the last day. And I want to ask you a question about that too, if that's even a thing. And I'm thinking that might not even be a thing. But well, anyway, let me just ask you that first. So
so the first one was we have to wait a little bit because we want WiMAX to receive the dividends from the individual tickers, right?
Okay, well, that's
but actually it has to be received. And actually, if you'll notice though, even though the like the individual tickers within WiMAX, their NAV drops until you get paid, the NAV on WiMAX does not drop, right? So we know it's a receivable, it holds the NAV where it is, but we still have to wait to get the cash before it can be distributed. So we, at the very least, we'd have a couple days that we had to do it. I think we thought it was also interesting to the investing community to have them staggered a little bit. But it does bring up the point that you just mentioned, which is, I hadn't called it. What did you call it? High yield tourism?
High yield tourism. Yeah, it wasn't me that invented that. Somebody on the internet, but it's funny and it's true.
Yeah. And I think you saw that in this last dividend, where if you averaged all of the yield, all of the distributions for the single tickers that make up WiMAX, it was around 40% or 38%. But yet the distribution for WiMAX was more like 31, 32. And the reason was the size of the fund increased during that time period from when the single stocks paid and then WiMAX had to have its declaration date. So there was a little bit of a lag there, and that will happen. That's what I'll call as, fund accounting. That's not my specialty, but certainly if the fund grew but the amount of money coming in didn't grow, right? The amount that gets distributes is going to be a little less. Now, that fund that happens early on in the life of an ETF. That can happen. Unless you're going to do something like what we did with some of the Yield Max and the Defiance funds, where we said, look, this is our run rate, regardless of the size. We may have a little return of capital, but it's more important that people understand the distribution that they're going to get is a little more stable. I mean, stable considering, right, how much they move, but at least the math is designed around how much we earned on a run rate. With YMAX, we did not do that because it's actually just, there's no real trading going on there, right? There's no active management, right? So anything we gave back in excess would just be, again, a return of capital. And in that scenario, we don't think it's warranted, whereas it is warranted where we are trading the options and there's active management. And even though you made money, it may look like you lost money and those kinds of things with what the YMAX structure has. So I guess I would say there was a little bit of that. I would say a little dilution, right? The yield got diluted because there was an inflow, but I think the fund is of size now where that will be a much, much more minor item. I think it was really a bigger deal as the fund got to, pass through the $50 million range. I'm not sure where we landed today, but we're probably in the 80 million. I should probably know that off the top of my head. I do not. I could look it up. But for that fund, I think it's going to be harder and harder to dilute those dividends, if you know what I mean. I will tell you on a personal note, as an advisor, YMAX is a good fund if you don't want to be active all the time, right? If you're building a portfolio and you're just looking for this idea of alternative income, higher yield distributions or higher distributions driven by option selling, YMAX is a good solution for a lot of folks. When I talk to advisors about YMAX, they actually like the fact that it's diversified. It's got 18 tickers in it, soon to be 19, right? At some point, there'll probably be 20, 25. It's naturally creating some diversification. You don't have to worry, is there something that's going to go on that Elon says or Cook says or Bezos says or any of those, personalities that can move a stock. You take away some of that single stock risk, right? And you read from my book, we like to have some diversification. It does help, but you're not giving up that much yield. I mean, yes, I know it's not owning Coin and Coney and getting, when we have those 100%ers, but it's all built in there for advisors. We found it's a better, that don't want to be too active. We found it's a better solution for them.
Yeah, of course, I'm a big fan of YMAX and YMAG, but I haven't asked you anything about ULTY yet. So we can wrap up with this one, but pitch ULTY to me. Why would I want ULTY more than YMAG? I'm looking at those two as kind of competitors, but give me the pitch on that and see if you can sell me.
Yeah, so the distribution on Alti should be significantly higher. We've only had kind of a half distribution so far. We thought there was enough in there to distribute, right? So you could do the math on the number of days alive and what the distribution rate was. It will be significantly higher. The idea behind Alti is, finding the stocks that are too small for me to launch a yield max product on and harvesting the volatility. Now, yes, we had Coin in the portfolio. We've had MSTR in the portfolio, but most of the holdings in Alti are, smaller in market cap. But because we have 20 individual holdings in that portfolio, you can add in. We had GameStop yesterday. Today I wasn't so happy with the results of GameStop, but you could add in those more volatile tickers that don't have the market cap or option capacity to be $100 million fund, right? But you could include them in an Alti because we're kind of unconstrained. And so the idea behind Alti is a basket of individual stocks that have some diversification, right? We never get more than 25% concentrated in a single sector. Some diversification where we can switch to the ETFs to the stocks that have the higher yield. There are some ETFs in there, by the way. LABU happens to be in there right now. So that's a triple biotech ETF. So we're unconstrained there. So it's just one of those things that it's really designed to rotate where the volatility action is. We all know that on those months where, Nvidia has an earnings release, that month and even the 2 weeks leading in, the volatility is so much higher in the options we sell. Well, Ulti is going to rotate through where there's more volatility. I would say YMAX and YMAG are more designed to be more stable. And yes, they're diversified, but it's more about stability and predictability of that yield. Ulti, I think it's for a much more aggressive investor that is looking for higher distribution rates and potentially higher returns.
Okay, yeah. I mean, I'm figuring it's going to be 120% or so. I'm figuring it's going to be more than 100. I know you can't tell, but I'm just figuring it's going to be
based on the rate of the first one. You're spot on, right? So, yeah,
exactly. A quick question about that, and then I'll let you go. You mentioned in a previous interview that you can look at the IV of the option, and that's kind of what you're going for. You mentioned that we have to go for a bogey before we have to get our bogey. Is that trying to make at least what the IV of the option is, or what does that mean?
Yeah, so with the typical single ticker yield maxes, like Tesla, or let's not pick a crazy one, or even just AMD, right?
Yeah.
We'll look at the 1, 2, 3 week implied volatility of that particular expiration, and that is the guide for us on to how much income we should make when we're selling our calls, and that'll determine how far out of the money we are going to be. So I mentioned earlier, there's a lot of times we let the options market tell us how to manage the strategy. That's a perfect example. So if the implied volatility on Tesla is 50, then great. We're going to sell for about 1% a week, and we'll find the strike that is generate around the 1% of income for that week. That's usually 2, 3, 4% out of the money. With Ulti, it's different. With Ulti, the options are usually, fairly juicy. And so in this scenario, we are more concerned about capping our upside because of the volatility. Remember, we just talked about during 2020, you don't want to get the whipsaw where you get all the down and none of the up. Yeah. We recognize that there's plenty of days where any one of those positions in that portfolio can move 15, 20%. And so we are more cognizant about raising our upside capture. I don't mind if it gets called away. Like if I sell a call that's 10% away and that goes in the money and it's gone in a week, I just made 10% in a week on that single portion of my portfolio. I'm happy. I'll take that all day. Plus I got a little income, but I don't want to limit it at 5, right? So again, it'll all depend. I don't want to tell you there's I think you'll figure out over time what our target income is going to be on the volatility we sell, but we want to raise the limit as much as we can within the individual tickers because I don't want to limit those snapbacks.
One more follow-up. I swear this is the last one.
That's okay. Go ahead.
You mentioned that you let the option market pick the strike for you.
Sure.
So, is that what happened to Tesla this week? I know there was a lot of consternation that Tesla couldn't have their option any further. Tesla couldn't put their ladder any further out of the money. It was the same price as last week. I always defend you, and I figure, look, they went ahead to the next strike and they didn't pay enough money. You guys don't understand. They have to, but I don't. Is that right, or am I wrong?
I mean, look, the volatility on Tesla, despite it going down over the last few months, so has the volatility been coming down on Tesla until the last 2 days. But leading up to if you look at a chart of the IV on Tesla, you see it coming down as the stock price is coming down. Normally, people don't think about that, but it's kind of this narrowing band of performance that is more of a driver. But you got it right. There was lower volatility. We have to hit our bogey, right, of what we're driving for, because the primary goal of any of the yield maxes is generating that option premium first. I know you've heard me say that a million times. That is our primary goal. Secondary is upside capture. And I would tell you that it's a sticking point for us as well. And, we recognize that it is a limitation of a covered call structure, right? Every covered call is going to go through that. We'll see what tomorrow brings on Tesla. I see we're up another 2 points today. We're definitely in the money at 179 on the strikes that we have. We'll see where we land. I would tell you that the option strikes we pick are leaning towards the most probable outcome, right? I mean, certainly plenty of times the market will move outside of what the options are predicting, but there are times with Tesla or ARK, right? OARK, our ticker, that you just don't get the premium that the stock ends up moving. Unfortunately, premium first, upside second.
Yeah, I got you. Well, Jay, it's been a real pleasure to talk with you. I appreciate you coming on here. It's interesting that you guys are so aggressive talking to little YouTube channels that only have a couple thousand people, but you guys are really into, I guess that's the way you market stuff nowadays. Nowadays, no one watches Bloomberg anyway. I mean, nowadays people watch little YouTube channels, I guess.
Well, who could get into this depth, right? If I did a Bloomberg interview and we start talking about, diagonal ratio spreads, who would watch that, right? So the good news is, so thank you. By the way, I'm happy to be here. This is, like I said, I like talking about it. I like getting, the information out there. And this is kind of the new way that, we get to communicate with our investors. It's almost impossible any other way. So, I appreciate all your coverage and appreciate your accuracy. You obviously know options very well. So keep doing what you're doing, Max. It's great.
Well, maybe after you get some new products out in a couple of months, I can get a follow-up interview. Maybe we could talk about that sometime, but maybe we'll do it during market hours. You probably can't, but I want to get into hedging, and I want you mentioned that we should do it during market hours if we can and actually look at some real trades. But anyway.
Yeah, that's a great idea. I'd love to talk about hedging. We got some other interesting products coming out, things that have been filed that you've seen. I think you'll appreciate the inverse yield maxes when they come out. And I think you're going to see some more Defiance funds as well.
And I have so many questions on all that stuff. But anyway, I'll save all that for the next time. But yeah, I am interested in the inverses. All right. Well, Jay, it's been wonderful. It's 5:30 there on the East Coast. Go home, hang out with your family. Have a good day.
Thanks, Max. Appreciate it.
All right. Thanks, Jay. I appreciate you.